Bloomberg Audio Studios.
Podcasts, radio, news.
We begin with our top story. It's Chair Powell Day 1. The Fed chair heading to Capitol Hill, where he's expected to reiterate the central bank's call to wait and see on rate cuts. BlackRock's Kate Moore saying this: while prices continue to moderate, inflation is still running above target, and we believe the Fed needs to feel a higher degree of confidence before rushing to cut rates. We view rate cuts will likely be appropriate in 24, and we believe that a June 1st cut is realistic. Kate Moore joins us now for more. Kate, great to catch up with you ahead of this testimony from Chairman Powell. We've pushed out the timing of the call. We've reduced the magnitude, and stocks have done okay. A theme for us this morning is just how important, how relevant is monetary policy to this equity market as we speak?
I think people are still fixated, of course, on inflation and on kind of the messaging and tone from monetary policy decision makers. That said, if you kind of look at the internals, John, and what has been performing within the equity market, it has been fundamentals that have been driving stock prices much more than just expectations around inflation. So when we initially got excited about inflation coming down, a disinflationary trend, and rate cuts in 2024, there was a pop in some really kind of lower quality stuff that was getting hit hard on higher rates for longer. But what is performed today and what is performing right now in this market are companies that are putting up good numbers on earnings, that have been raising guidance, and that have very strong fundamentals. So we're going to talk about it till we're blue in the face. Inflation and Fed policy and parsing all of the speeches is going to be what we do for hours on end. That said, we really have to focus on what companies can perform in this economy in order to make money.
Okay, for years you and I were talking about pricing power. When inflation was high, they had this ability to kick up prices and boost margins. Have you been impressed by their ability to preserve margins given the backdrop currently?
Yeah, John, I think you're asking this question because I have great faith and confidence in the U.S. corporate sector to continue to maintain margins, even through lots of last year where prices were rising and where there was a lot of strain. We saw companies continuously focus on maintaining margins and think about strategies that would allow them to expand their margins in 2024. I'm actually very optimistic, and I think this is the consensus of a lot of analysts on the street, that margins will gradually expand over the course of this year as prices come down and as companies continue to have this laser focus on maintaining and expanding margins. This is going to be critical for the fundamentals. And as I said, the fundamentals are going to underpin equity risk and sentiment, I think, for the balance of this year.
So your overweight risk assets, strongly overweight risk assets, piling on, shrugging off all the bubble talk. Are bonds a good diversifier? Or right now, are they the toxic ones at a time of concern about deficits and inflation being stickier for a longer period of time?
Yeah, look, we have a significant portion of our portfolio in bonds, but we're not massively overweight when it comes to, say, treasuries. We're seeing a more opportunity in the credit side. I think the fixed income plays an important part in a balanced allocation portfolio. That said, there are lots of parts of fixed income that are more attractive than others. And we've used cash as a tool aggressively over the last 12 to 18 months. We're seeing more alternatives and currency opportunities as well. So I think we need to think holistically about the asset class opportunity set, even though, Lisa, and you know this, I'm very constructive on equities for the balance of the year. We're going to get this periodic pullbacks, but I think that is where you're going to deliver the bulk of your returns for a multi-asset portfolio.
Kate, I've been putting together a project where I'm trying to collect all the worries and put them on a list and then tick them off as people basically shrug them off. Do you have any to put on the list?
Of course. I barely slept last night thinking about all of my worries. No, Lisa, for sure. There are a couple of things that really concern me. One of the things I'm focused on, and we were paying attention to this with Target reporting yesterday, was what is the true health of the U.S. consumer. Some of the data gets masked by the higher end, or we'll think about the upper two quintile of earners. Does low-end consumer continue to show cracks, and what does discretionary demand look like? I worry a little bit about that. I frankly worry a little bit about the election cycle having an impact on overall spending. We've seen in previous election cycles that companies pull back or hold back on non-essential CapEx as they're waiting for, trying to figure out who the next administration is going to be and what that policy will look like. So I worry that could have a dampening effect on overall economy. And then I worry a decent amount around the impact that geopolitical risk and geopolitical tensions could have on multinationals in terms of their overall operations. Does any of this take my enthusiasm out of the S&P and NASDAQ. Not fully, but I think these are things that could be risks for certain sectors as we look through the year.
Okay, I was going through your old calls at the end of last year. Credit where it's due. Top favorite markets. US one, Japan the other. US up by 6.5%, Nikkei 225 up 20% this year. What was it that you liked about Japanese equities? What is it that you still like about Japan?
We've seen a bunch of small green shoots, I would say, across the Japanese equity space. And there was also a large positioning and technical component, John. You know, Japanese equities had been underloved for some time. We continue to see, stronger growth across Asia and with some of the trading partners that we thought would bolster earnings across the Japanese corporate sector. And we, like a lot of people, remain hopeful that we will continue to see a change in BOJ policy over the balance of this year, which will change sentiment for the overall asset class. I will say U.S. is our largest overweight by a long stretch, and that's where we're taking our concentrated equity risk. But I think Japan continues to bear some fruit, and we'll continue to have an overweight there through coming quarters.
Some pretty decent fruit, that's for sure. Kate Moore of BlackRock, congrats on the call. Big call. Japan, just massive outperformance year to date so far.